Great, great.
Pay
So
your
this
fare.
is the hotel valuation panel, forecasting change. These four up here are going to tell you everything you need to know going forward. My name is Catherine Morgan. I'm a partner at Morris, Mang & Martin law firm here in Atlanta. I tend to represent owners, operators, developers, lenders from time to time, all in the hotel space. Pardon the reading glasses. So Rod Clough,
Very good, very good.
is president of HVS America, where Rod oversees strategy execution for HVS throughout the 40 Americas locations. In his 25-year tenure at HVS, he's been critical to its impressive growth, in particular as it relates to the topic today. In 2003, Rod founded the firm's sister appraisal division, which completes roughly 1,000 appraisals annually. Got Scott Stevens is a senior principal and CEO with HREC Investment Advisors, brings more than 30 years of investment banking and advisory services to the hospitality industry, and he's a Florida State grad, so that's great. Todd Ratliff, Managing Director at Hodges Ward Elliott, one of the premier brokerage and investment banking firms in the hospitality space, brings a lot of experience as well. Unfortunately, Al Calhoun was unable to join us, but we have a great fill-in with Lee Hunter today.
Doing his day job.
One of the things I really like about this conference is you have Georgia State hospitality students all the way to CEOs of major hotel companies. But just for the benefit of maybe some of the newer people in the room, I thought if Rod could give us the really super quick kind of 101 basics of hotel valuation, that might be useful as a nice framework for what we're talking about today.
Sure. So we have an acronym called IRV, which is income over rate equals value. That's the most simplistic way to derive a hotel value is taking that the proper NOI number and dividing it by a cap rate. I'm happy to explain more in more detail with any of you that want to do a deeper dive. We at HVS and other appraisal firms will look at multiple approaches to value, one being income, and we derive income from a couple of different methodologies. And then we also look at comparable sales of like hotels to bracket a reasonable range of value for a property, and then we'll consider the cost approach. And so by going through that process of evaluating those points of view and those numbers, we're able to reconcile what a proper market value is. What's most important is talking to the market, talking to buyers and sellers, talking to brokers, making sure that you're up to speed on what those right cap rates are, what the investors are thinking, where the minds are coming together, and not getting stuck in just looking at the numbers and being sure that you're really reflecting the right point of the market. So
Great. So I hope the conversation today gives some of that conversation of what everyone's seeing. So maybe we start, Todd. So how are you finding the market today versus kind of last quarter of 2022?
Different than we thought it would be, right? I think I was laughing because we're talking about forecasting the future, and we've consistently gotten it wrong every step of the way. So just take that with a grain of salt. And I say that we collectively as an industry, right? At the end of 22, I think everyone was kind of looking to the second quarter of 23 and thinking, hey, the money center banks will be lending again, right? We'll be away from the debt funds. Debt will be more plentiful and readily available at tighter spreads. And it just hasn't manifested. And obviously the last week has changed a lot as well with all the regional bank disruptions. So I think from a transactional standpoint, we continue to do a lot of BOVs as we help people try to understand what the value of their asset is in the current environment. But you still see a dearth, particularly on the institutional side, of institutional assets on the market. There's probably a fair amount of what I'll call secondary and tertiary market full service and select service opportunities out there. But in the institutional space, there's not a lot of depth right now, which is understandable.
And Lee, this is probably a good question since, this is your conference. Thinking about, what the conversations were like last year this time versus now, how much is kind of on track, totally different, just new things got thrown in the mix that no one quite expected in this way.
Well, I think it's not just the last 12 months. I mean, as Todd said, it's the last 3 months. The start of the quarter, the discussion was, yes, all the big balance sheet lenders will be back lending and, start of the third quarter. They'll have recycled some of that paper. They'll be back in the market. And that's not the case right now. And again, that was just 3 months ago. The thinking was they'd be back. And they're not. And that's causing a lot of, I don't want to call it dislocation, but a lot of, it's causing things to slow down and maybe not move as quickly, churn as quickly as it might normally would.
I'll add to that. I mean, he's right. The larger banks haven't really come back into play, but up until last week or so, the local and regional banks were still lending for smaller deals that say sub 30 million or so. I mean, that was full recourse, but for someone still that was willing to sign, they could still get a decent loan at a decent rate. Last week, that completely changed, and we still don't know how that's going to play out.
Yeah,
Hopefully, it won't be long term, but
the local regional lenders are the only debt sources that we've been able to get transactions closed on all year.
Yeah.
But then again, last week that changed.
Yeah.
Well, and it just, it goes to the point that it's really important and vital to have strategic relationships with these lenders. I was talking to a regional lender this morning, and their point was, 9 months ago, we basically shut down any new inbound clients, and we're focused on the existing relationships that we have. They still plan to fund their commitments despite the disruption over the last week, but I think it's imperative, if you don't have strategic relationships, you should start to build those. It may not help you over the next month or two, but long term, it's important to have those relationships for sure.
that's good advice.
We've also seen from our appraisal side, the business has really slowed down quite a bit, and but parroting the same thing, the deals that are coming forward are from really strong buyers that have really strong balance sheets and really good relationships with their lenders. I've also heard, and I'm interested to hear from you guys, if you're seeing the same thing of opportunistic buyers going in for all cash and knowing that in a few years they'll go out and get some debt on it. But are you seeing any of that, or?
Oh, absolutely,
Okay.
absolutely. Yeah, I mean, especially like I mentioned before, 30 million and under, it's a little different, but for, the 30 million and over, yeah, there are definitely groups out there. I've talked to a lot of them at this conference.
So it's not just on the smaller deals that they're going in
Even
all
the
cash.
larger deals, the more they're willing,
There's
there are
not
some
much money
buyers that
out
are
there.
willing to go in, pay all cash, and then refinance when they can. Don't know if that's a year from now, 2 years from now, but there are groups out there willing to do that. Now, of course, will that affect pricing? Yes, because it's all equity, but they are willing to do it.
And the other thing to add to that too is if you think about it, right, with interest rates where they are today, so debt fund pricing is circa 500 over, right? So if your SOFR is at 475 today, you're somewhere in the 10+% range if you're originating new debt today. For perspective, we're 475 SOFR today, it was 30 basis points a year ago. So not only we had massive blowout in the index, which we can all track back to the Fed's movements and actions, but you've had spread increase, right? Because these big money center banks aren't lending. So the debt funds have kind of had their run at the table. So if you go borrow at 10% and you borrow and you buy something at a 7.5 or an 8 cap, it doesn't make any sense, right? It's a negative arbitrage play. So it's not accretive to take debt. You're actually suppressing your cash on cash yields. So the buying all cash actually yields more equity or yields more return in the short term. But I do think, not to jump ahead, but I do think there's this expectation that hopefully the Fed maybe make the last movement today, and then you'll start to see some cooling in, it may be 12, 18 months. So they're not looking at forever, but they're looking at, 12 to 24 months as a potential point to re-enter the debt markets.
So those are the sorts of sources for debt that people are finding now, or kind of debt funds, that sort of thing. Are the big banks getting back into it in like the last little bit? I mean, I've had a couple of people tell me that they're back, and I haven't seen it in deals yet, but.
We got a quote, I think a week ago, out of one of the big banks. It's the first quote I think we've had in a while, which was surprising. But to Rod's point, I mean, it was, kind of best-in-class asset, best-in-class sponsorship. So I don't think that that's indicative of, a trend. The one thing that popped up about 4, maybe 5 weeks ago was I started having conversations with JP Morgan's CMBS desk, and those guys are starting to look at stuff on 10 and 5-year product, and they were quoting in the 6s. Now they're pricing something this week that's closing, so it'd be interesting to see if the disruption last week has impacted this at all. But they were quoting a 10-year product in the 6s, fixed rate. So depending on the asset and multiple variables, call it 6.25% to 7%, and 5-year product that was circa 7 to maybe low 7s, maybe 7.5%. So you could make a case now that you have another voice in the room, and maybe you're not traditionally a CMBS borrower, but there's a kind of a more cost-effective approach potentially taking that 5-year product as opposed to a 10. You get a little call protection, right? And then have the ability, even if you have to defease it, net to save yourself money because of the spread and rate and points and capper and everything else you have to buy. So it's at least good to have another option other than debt funds.
As the lawyer on the stage, I hate this.
I know you do.
Yeah, so,
Because
so
3 years
why do
from
you-
now, you're like dealing with some random servicer that like doesn't know you. There's no relationship. It goes. It's hard.
But the
It's
5-year
hard.
the 5-year product is interesting because, like Todd said, you're not locked in for as long as you were before with the 10-year.
Right.
So
Yep.
I think it has a place in today's market.
Are you finding that just anybody can get that kind of a product, or is it again that really strong?
Yeah, I mean,
Borrower.
they've obviously got the requirements, right?
Yeah.
That they'll need from the borrower. But again, I think it still comes back to asset quality, right, and story. Now you need, it's not these aren't pro forma loans, right? You need an asset that's got in-place cash flow that they can map to, and they're looking for I'm trying to remember what they gave me the other day, like a 140 coverage ratio. So it's wider than where it used to be, for sure. But it's causing people that might not otherwise look at CMBS to suddenly go, hey, maybe I should take the 5-year and wait it out and see what happens over the next 24 months.
What was the loan to value on that?
Ballpark kind of 60%.
Yeah.
So it's not super high.
Right.
And it all comes back to that coverage ratio, right?
Yep.
So depending on what you're paying, they're going to loan you based on that coverage ratio.
I think one of the conversations I've had a lot with clients is trying to put together deals or buyers and sellers just not on the same page. And so I'd like to ask you to talk about kind of trends on the bid-ask spread today versus a few months ago. Is it getting any better? Is it
No,
worse?
From what we've seen, there's been a 20 to 25% decline in asset value over the last 6 months. And that's purely a function of rising interest rates. I mean, IRV is a mathematical equation, right? One of the pieces of that equation is interest rate. So when interest rates go up, cap rates go up, values go down. Again, it's a math equation. And so I don't think, what I've told our team, back at the start of the year was, hey, our clients need to, and you guys are probably having the same conversations, what's the client's motivation to sell?
Yep.
Because if motivation to sell is, hey, I want that high price that I could have gotten in 21 or 20, or I did get in 21 or 22, well, that high price no longer exists, so that better not be your motivation to sell. Now, motivation can sell is, hey, we got 5-year CMBS data, our business plan's a 5-year hold, and it's year 5. Okay, we're sorry, values are down 25%, but we're a 5-year hold, we're sellers. It can be, I've got debt maturing, and let's pick numbers for talking purposes. I got a $10 million asset, I got a 70% loan, so I got $7 million in debt. I go to refi that, and DJ Rama with Oro said it yesterday on his panel. Okay, your bank, who you have that existing debt with, yeah, we'll do it. Your value's not 10 million, it's 8, and we're going to give you a 60% loan to value. So we're going to give you $5 million in proceeds to pay off a $7 million loan. Okay, I'll show up at closing with a $2 million check in my example. Now the question is, do you have that $2 million? If you have it, do you want to put it into that existing deal, or would you rather put it in a new deal? You know, those are all motivations to sell, right?
Meanwhile, you're getting pressure from the brand to renovate.
Meanwhile,
Right.
you're getting pressure from your brand to do a PIP, and that might be motivation. Hey, I just got handed a, $40,000 per key PIP, not 20,000, 40,000 per key PIP, and I got a 100-room hotel. I can do that math. Do you have that money? If so, do you want to put it in that deal? So, we've told our guys, check the motivation to sell, and if it's, hey, I want high price, then that seller's not motivated, and go spend your time elsewhere. Because, all of us have run processes over the last few months, and we've shown up with multiple offers, again, picking numbers for talking purposes, $17 million for the asset, and the seller's like, I'm not selling it, I need 20. Well, I got 15 offers that all say $7 million, and here's why.
But also, like you said, Lee, I mean, because of the high interest rates, because of high PIP costs, because of labor issues that are still out there, yes, that's all driving values down. But yet, operators, especially like where I'm in Florida, they're looking and say, hey, my performance in 2022 was well above 19, and you're telling me that the value of my hotel is down 20 to 25%? I mean, the answer is yes, but once again, it goes back to the motivation. Like, well, enjoy the cash flow while you can,
That's right.
and just, don't sell.
And it's at that point we say, yes, don't sell.
Right.
Because
Which are terrible words for a broker to say, by the way.
Yes.
But we've been saying that a lot lately. I mean, that's where we are. And also what Lee said, I mean, the cash-in refi scenario is not necessarily a popular one, but it's reality. If you want to hold on to the asset, if you have a debt maturity coming up.
yeah, I mean, like DJ said yesterday, he's working for the bank.
Yeah.
I will say I think there is some exception to this, though, right? I mean, I think it's kind of a generalization of where we see the impact, right? But for great assets, right, there's been this flight to quality. So in a lot of Florida-based, particularly oceanfront stuff, impervious ski markets and the like, right? You see a lot of demand there, and you haven't seen as much degradation of value. So particularly if you have a long-term view, some people are going in there and they're saying, hey, I can buy this even if it's a slight discount, right? This is a great time for me to acquire an asset. Long-term, I'm going to be fine. Interest rates are going to come back to me on some level. So there's it's a little bit of a barbell, I think, right? And so those deals we're actually able to get done. The other end of the barbell would be the kind of really difficult stuff that's really troubled. And those are selling because sellers are having to meet the market. And then you got everything in between, which is largely what I think we're talking about, which is this is hard to get done because sellers just, I was telling somebody earlier, we gave a couple of values last week to a big PE shop, and they were kind of stunned, right? And I said, yeah, it's like, this is not the time to sell these if you don't have to, because these assets are going to be fine, but they're so impaired right now, it's just not worth trying to monetize them.
Agreed.
I think it's important that you don't paint any broad brush across the market, that there's all sorts of different types of deals and submarkets. We're seeing those on our end where one asset, one submarket, it'll be really difficult to build in. Construction costs are super high. There's plenty of land, but there's just no movement on the development front. And you could have a really nice upper scale limited service hotel that's just screaming that everybody wants to get their hands on, and that's a much easier play today than something where you've got 3 hotels under construction or coming out of the ground, and maybe not such a strong brand name, and something that's 10 years old, 20 years old, that needs some major renovation. That's where I imagine you're getting the big gap in that bid ask. Whereas on the flip side, it could be quite different. And it might be a function of the types of deals coming forward, but we're seeing right now in our modest brokerage arm that the bid ask is not that as high as what you quoted, but it also is probably a function of the fact that most of their deals are in Texas, and they're perhaps smaller deals. So think it's a tale of the submarket that you're in.
Well, and Lee, you hit on this, but I think one of the biggest disconnects for us right now is on PIP cost.
Yep.
Because every seller thinks it's 15 to 20 a key, and the PIPs are coming back and they're materially higher. And it's, you know, deals that might otherwise get done in the current environment, despite the challenges we're talking about, aren't happening because of that.
Yeah.
And then the existing owners, the brand's kind of pushing them on the PIPs, and
Sure.
they use their CapEx during COVID to keep the lights on, and
Yeah.
puts a lot of pressure.
Yeah, everybody got deferred, right?
Right.
So it's just, now it's time.
Yep, now it is time.
So are you seeing people kind of going in looking to kind of flip brands just because of that? You kind of avoid, you know, one PIP for a different sort of thing that may be more cost effective or something like that?
Yeah,
Yep.
yeah, 100%. I mean, we were talking about a deal earlier today, and it's like you can do this or you can do this. And there's some optionality there. And so you have to kind of hold it up to the light and say what makes the most sense, given all the variables in play.
I mean, at the end of the day, it's what's your return threshold? You know, what are you looking for from a return, and that you'll almost back into what you can pay, what brand you're going to put on it. Are you going to do the 50,000 a key PIP or the 30,000 a key PIP, right? So it's where's that return threshold, and that's different for every investor.
And are they having to just, you know, it's a different environment, so they may be a little slow to adjust, but they're ultimately having to adjust somewhat.
I think you have to face the reality of, at some point, you just have to face the reality of what the market is, and that 2019 is becoming more and more distant in the rearview mirror, and perhaps getting back to what 2019 was is a fallacy. I mean, it's just probably not going to happen because we've just evolved into a new market. And even today I was hearing these predictions of, well, we'll get midweek corporate will return the way it once was. And I don't know that it can return to what it once was because we just live in a different reality today. And there's plenty of opportunity and revenue in other pockets of the week. And so it's refreshing to, whenever you talk to somebody and it's more a viewpoint of we're not going to go back to 2019, we're just headed in a whole new direction. So
we've talked about like a number of pressures that are kind of on both sides of things. So how is that affecting kind of listings and traction on listings?
I mean, I think the number of listings are down, certainly compared to, you know, first 3 quarters of last year were great. Started to slow down, you know, last quarter, and it has continued. I mean, like, I think, don't you guys agree with that?
A lot more BOVs that
Yeah.
don't make it
Yeah,
to listing.
BOVs are,
Because
you know.
people want to know, like, where's my value at?
BOVs are
Okay.
going through the roof, there's no
Yeah.
doubt about it. But
Yeah.
we'll see how many of those turn into actual listings. It's hard to say right now.
So how do you kind of go about kind of factoring in these PIP costs when construction costs just seem so variable, so all over the place, hard to pin down, particularly if you're looking forward far at all?
You know, a lot of companies, they'll call us up and say, hey, we'll price your PIPs for you, right? They call all of us, hey, we'll price your PIPs for you. And that, in some cases, is very good to have in hand, because we're not professional contractors, right? We don't know that, but a lot of contractors they'll call, hey, I see you've got this, we're in that market, you want us to help you price the PIP. Obviously, they're doing it for reasons, you know, that they want to handle the business when it gets done. But we've all done deals that, okay, we got 10 offers, and every group who has made an offer has the PIP from the brand in hand. Here it is. We're not making it up. Here it is. You go price it. And we'll come back with 10 different pricings
Yep.
on the same PIP
And a pretty wide range.
and a pretty wide range.
Yeah.
It feels like the lead time, though, logistics have, I mean, still not perfect, but has calmed down a lot over the last year from where we were. Are you guys seeing that?
On the PIP,
No, just the logistics of supplying, getting the materials on site, et cetera.
we're hearing that it's getting better.
Yeah.
we're hearing that it's getting better.
Yeah. But again, I think people are just underpricing sellers.
Yes. Sellers always underprice pips.
You know, the other thing we're talking about values that's so important right now, it's always been important, but is license term. I mean, you know, whether it's you're going to get remaining term, get a 10-year license or a 15-year, I mean, it can have a great effect on value. I mean, I worked on one deal, for example, that we started, I won't name what brand family, we don't need to talk about that, but you know, they told everybody, we're only going to give you 9 years, that's what's left, no matter who you are, that's what we're going to give you. It ended up affecting the value by about $3 million, and it's on a $17, $18 million asset, so a major effect. And so we went under contract at that number based on the 9-year term. Well, midstream during contract, they changed their mind and decided to give a 15-year term. I mean, it was, you know, I mean, who gets affected? It's the owner, right?
Sorry.
But it happened. So, I mean, it really is important, is that license term.
Yeah.
That's interesting. We've always had it, not always, usually have had it go the other way.
Oh, yeah. Yeah.
Well, not yet. We'll give you the remaining 9 years, and then as you get through it, yeah, no, 5 is what we want to do, and then it affects it the other way.
So we talked about a few of the kind of price limiting factors right now with, you know, debt maturities and PIPs and that sort of thing. I think we had brought up a couple other ones talking about like property insurance and energy costs, those sorts of things. Are they factoring in more today than say they did, you know, last year?
Yeah. Particularly in
Just
South
so you
Florida.
Yes, or anywhere in Florida.
Anywhere in Florida.
I mean, you know, it doesn't matter where. I mean, obviously, the closer to the coast, but it's having a major effect in Florida and elsewhere, California and any coastal area for sure.
Yeah.
So that's probably the biggest hit on value right now, and there's a lot of uncertainty with that. It's hard to know what to actually underwrite.
Yeah, we're seeing it in property taxes too, especially on deals that the owner is the original developer of the hotel, because their property taxes are whatever the dirt cost, right? And so let's say the dirt cost $1 million, now they're going to sell it for $15 million. Well, the real estate taxes in the current P&L are very, very undervalued, you know, so there's going to be a huge step up in property tax line items.
That's why you got to buy in Texas, non-disclosure state. So.
We're seeing that too on the valuation side, where operators are very proud that they got their house profit back to where it was pre-COVID, and before you really look at what's happening in those fixed expenses. So just a super important part of your investment process to make sure you nail down where those are headed and how that's going to affect the bottom line. Those are things you are really, it's impossible or really difficult to do anything about. Just to pivot slightly, we worked on a recent assignment, which I know is nothing new for the industry, but where a buyer, in order to kind of deal with these realities of the higher fixed costs, came in and bought an adjacent property so that they could share management across both hotels and kind of spread out some of those variable costs so that they could kind of not only better manage the fixed costs that were rising and labor costs and all of that, but then drive, just in today's environment, those kinds of solutions make a lot of sense because you're able to drive a lot more profitability out of a hotel that you're buying by being able to have one GM now over 2 properties, and everything along those lines. So I thought that was a neat, pretty good solution. I don't know if you're seeing any buyers on your end kind of purposefully looking for assets. And then, of course, this was done off market because they found the asset that they wanted and they were able to put it together. Anyway, it was a good solution.
One thought real quickly when I'm thinking about this, so on the cost standpoint, this can impact value, and this is material. If you've bought assets across the country in different markets, you know transfer taxes vary. And most notably, Los Angeles is set to impose a mansion tax. I think it goes into effect April 1st. And it's going to be 4% of transfers of assets at a $5 million or greater value and 5% over $10 million. So it's designed to be this mansion tax, and they're going to use the money to help with the homeless problem in Los Angeles. But if you're selling a $100 million hotel in LA, you're going to pay $5 million in transfer tax as of April 1.
I can help you structure that.
Yes. She's going to bifurcate the fee and the leasehold. And
You'll have multiple entities that
That's
don't
right.
have a control of majority.
That's right.
So-
That's
so
above
tell-
my pay grade.
Tell us more about that. Like, how do you structure it?
Well, working on one now, and I mean, we're kind of guessing it will work this way because I don't think all the rules and regulations are kind of out. It hasn't been in effect yet, so you don't exactly know, but it's very similar to one they have in San Francisco. And our understanding, with help of California Tax Council, is that you may split up the ownership, do an entity deal, split up the ownership amongst multiple entities, none of which have a 50% interest, and there's ways to work with it that hopefully actually work.
Okay. Okay.
It's just like a drop-down entity you create. Interesting.
But you end up with kind of multiple entities. But it could be a little tricky because you often have, you still have to deal with the control rights for things if you've got a JV
Right.
with a sponsor and all of that. But there are definitely tax lawyers out there that are working very hard to figure out the best ways to deal with it.
It's good advertising with Catherine, though. If you guys don't have great legal counsel, she's amazing.
Very nice. Okay, where were we? We talked about property insurance, energy. Are labor costs getting any better at all? I mean, maybe you can find more people, but the costs are just as high or worse. Not-
Yeah, I mean, it's all, it's all encompassing, right?
all
Labor
interconnected.
and insurance and property taxes. It varies by market, varies by submarket. So it's once you start getting into the weeds of where you are and how you look at it. It's going to be interesting today. 2 o'clock, about the time we're finishing up here,
Yeah.
Fed has, will have their announcement as to what they're doing with rates. I think everybody in this room would say they're going up. It's only by a question of how much. My question would be, okay, at what point would they start coming back down? Or
What has to happen?
well, we've, I'm not going to say how long we've been doing this, but we've been doing this for a long time. Where have interest rates been historically? Not 3, 4, 5%.
Right.
They've been closer to the 6, 7, 8, 9 that we're looking at right now, and everybody's panicking over. So at what point were we in an abnormally low interest rate environment over the last 5 to 10 years, and we all got spoiled? And somebody from the general session stage said it either yesterday or this morning. Oh, when we go back to normal.
Well, we are
This is
normal.
Wait a minute, we are
Yeah,
at normal. 6, 7, 8, 9%
Yeah.
is normal. We've just been spoiled the last few years. So I mean, that's the question I'd be interested in you guys. Do y'all are we at some point going to go back down? And if so, will we ever see 3, 4, 5% interest rates again?
I think we are modeling, I know we are modeling a future where there is a refinance expectation at a lower interest rate, but doing so because that's what we feel the market is thinking is going to happen, even though sometimes what the market thinks isn't necessarily reality, because we're such an optimistic bunch. And so that's still kind of in HVS's thinking, is that this will, yes, we are, in my opinion, we are kind of getting back to normal, but yeah, maybe once things normalize, the rates will go back down. We can hope, I guess.
Well, and again, you've got kind of two variables at play there, right? You've got the index, and then you have your spread. And if you look at the forward curve on SOFR, I mean, you can see kind of what the people way smarter than I am are thinking is going to happen. Of course, that changes every time the Fed makes a movement. But if SOFR trends back to 3% in 24 months, and spreads go from 5% to 300 basis points, all of a sudden you're kind of 6% debt versus call it 10% today. So to your point, I don't know if it goes to 4 or 5 in the near term.
Right.
No.
I think the Fed's got to take action, and there's got to be some reason for them to take the rate back down low. But I will say this, and this kind of ties into this, right? If you think about it, when you're modeling an investment, if you're taking just a typical 5-year IRR model and you're forecasting your exit in year 5, what's your terminal cap rate right now, right? Because there's always been a correlation between where's your interest rate and cap rates and the spread, right? So now all of a sudden you're going, well, now I got to guess where that's going to be 5 years from now, and how am I going to correlate that to what the right terminal cap rate is? And if a significant portion of your return is in that residual and not in your cash flow, being off on your terminal cap rate could blow up your whole deal. So it's tricky, and I don't have the answer. I'm not, it's not leading. I'm just saying it's difficult for all of us, right? As we think about what's the right.
And that's why I'm asking a question. Where do we think we're going to be?
Yeah.
Because you're right. If you miss it, if you're planning on it in the residual and not over the cash flow, life of the asset and cash flow,
Yeah.
that makes a big difference.
Yeah, we look very closely at how much is coming from cash flow from the asset and how much is in the residual to make your return. And today I'd feel a lot better if I'm getting it from cash flow, clearly.
Yeah.
Don't want to lose anyone. One question was, if anyone has kind of run into kind of partnership issues as a reason to sell. Like post-COVID, there's, different partners wanting to do different things with an asset,
I don't think it's necessarily COVID related. Those are always there.
Yeah, I was going to say that.
You're always going to run into partnership issues. So yeah, but that goes back to what you said, finding someone who has a compelling reason to sell. Debt maturity, end of fund life, partnership issues. It's all kind of go together. So I don't think they're any more prevalent now than they were. It's something that's always there.
Yeah. One of your colleagues yesterday taught me that secondary motivation is a key term I should use for up here. But you had brought up like a really good kind of value add strategy that buyers using, kind of maybe looking at dual brands or properties adjacent. Are there any other ones we should kind of be thinking about? I know I have clients that haven't done a whole lot in the extended stay space that are doing more of that, I think because the construction costs are a little easier to set, their labor costs are a lot lower, so they're moving in ways that they haven't traditionally, thinking, it might make more sense in this environment. Is there anything else?
I am a personal big fan of the extended stay market. Big fan, big fan of the extended stay product. Now that being said, I did have a conversation yesterday with a chief development officer for one of the brands who was saying their extended stay product, on a construction cost perspective, has gone up 20% in the last few months. So we used to be able to build these things for $100,000 a key. It's now $120,000 a key, which throws off your operating model only a little bit. But those things are absolute cash cows. Yeah. And we sold in 22, we sold a bunch of them to the buyer profile was a developer. They were developers who had developed Hilton and Marriott Select Service product for $125,000 a key. They sold it for $200,000 a key, and they turned around and bought every extended stay brand they could buy. And they made their money on the development side, and they were retaining their money by owning extended stay assets. And they'll be the first to tell you, I have a machine in the back, and I turn it on, and it just prints out money. And if you have an extended stay product in the right market.
Yeah, in the right market that has true extended stay
that
demand.
has true extended stay demand, and you're not just a bigger room renting nightly. If you have true extended stay demand, I'm a big fan of that as an asset class.
Well, we only have a few minutes left. If there's any questions from the audience before we wrap up.
Quick question. Are you seeing things trade at that 25% discount that you stated earlier, valuation?
Yeah, 20, everything that we were under contract with in the fourth quarter, and I mean everything, if money was not hard, got retraded by about 20 to 25%. Everything we're putting under contract now is down 20 to 25% at contract price.
Compared to what point of time?
Compared to
Last May?
the second half of 21, first half of 22.
Yeah. That's right.
If you're,
Some are.
some are, some are. I mean, and as Scott said, it's never fun for us as brokers to say, but we have said to quite a few clients recently, do not sell your asset. You're cash flowing, you're locked in at a 4% interest rate, you're covering debt service. Here's the number where we could sell it for you. That number does not work for you. Retain the asset, cash flow, and let's revisit 18 to 24 months from now.
But like Todd said, I mean, that's not everything. I mean, there are still deals, beachfront, urban, irreplaceable locations, just high barriers to entry, where people are still willing to push pricing. So it's not all doom and gloom. It's just every situation's different.
Any others? Okay, in that case, any wrap up, anything?
Thank you for moderating.
Yes, thank you.
Thank you.
Thank you, and thank you, Lee, for stepping in.
Yeah.
adding to
Thank
the
you,
panel.
Lee.
Very
Happy
much.
to do it.
Everyone have a great afternoon. Thanks a lot.